Yes, in our last class, we started capital budgeting, and then we were able to solve only one illustration after extended hours for the explanation of the concepts. So today we are going to have additional illustrations to further buttress our points on the subject, on the topic. So without wasting more time, let me see. Okay. Illustration two. Yes, let's solve this illustration number two. At least this will demonstrate the understanding on net present value, IRR, payback period. Then we can include accounting rate of return. Okay. Yes, I will read. Orimolade Nigeria Limited is currently considering two mutually exclusive investment projects. Both projects are concerned with the purchase of new plants. The company made available the following data for each project. Orimolade Nigeria Limited has an estimated cost of capital of 10% and employs the straight line method of depreciation for all fixed assets when calculating net profits. Neither projects would increase the working capital of the company. The company has sufficient funds to meet all capital expenditure requirements. Required. A. Calculate for each project. 1. The net present value. 2. The approximate internal rate of return. 3. The payback period. B. States which, if any, of the two investment projects the company should accept and why. So this is the question. This is a very straightforward question. And however, I must confess to you that an average student can get this question very wrong. Yes, you may score 0 in this kind of a question if care is not taken. The question looks very simple and straightforward because of the requirements. This particular question does not involve taxation, inflation, doesn't involve multiple variables. So very direct and straightforward. However, examiner has hidden something in the question such that an average student that is so eager to solve because you have found or you have seen a very simple and straightforward question without paying particular attention to the contents of the question, then there's tendency for you to make avoidable mistake. Why am I saying this? I explained to you last time that when calculating capital budgeting, especially calculating internal rate of return, net present value, payback period, every other techniques in investment appraisal, apart from accounting rate of return, that you need cash flow. You are going to need cash flow to calculate all those, to solve for all those techniques, apart from accounting rate of return. However, when you look at this question, examiner wants you to calculate NPV. You are asked to calculate net present value, internal rate of return, and then payback period. However, when you look at the financial data given to you, you will notice that examiner did not provide you with cash flow. Rather, what examiner has hidden for you is you are given expected net profit or loss. Examiner has given you profit or loss. But an average student, my point is the fact that an average student will not realize that this is profit or loss. He or she may think that this is cash flow and just begin to solve straight. Begin to solve net present value, IRR, and the other, and the payback period. Whereas accounting profit or loss has been given to you, not cash flow. Therefore, your first task, your first working that you are going to do is to convert all this all this profit or loss. You have to convert it to cash flow before you can calculate net present value. Because as far as NPV, IRR, payback periods are concerned, you don't need accounting profit. Rather, you need a cash flow. So if that is the case, I will stop sharing this particular document. You can open to your own material on capital budgeting. So let's go through it together. I want to switch to the working note so that's, yes. All right then. So the name of this company is Orimolade Solution to illustration number 2. Is it number 2? Let me confirm. Yes. So solution to illustration number 2, Orimolade Nigeria Limited. That's the name of the company. Requirement number 1, examiner wants us to calculate net present value, IRR, and payback period. And these are mutually exclusive projects. So I need to estimate the pages for my main calculation. So page 1, page 2, possibly page 3, then I can go to page 4 for my workings. So I would then say workings, because I can't go straight to calculate NPV. I need a cash flow. An accounting profit or loss have been given to me, so I need to convert that to cash flow. Therefore, working number 1, I need cash flow. To calculate cash flow equal to, for this purpose, cash flow is equal to accounting profits or loss plus annual depreciation. Simply put, depreciation. So this will give me cash flow. So if that is the case, from this formula, you can see that there is depreciation. Therefore, I need to go and do working for depreciation. But first thing first, I will calculate cash flow for project A. In calculating the cash flow, I'll create a column for year. The useful life of the project are 3 years. Year 2, year 3. I'll create a column for profit or loss. I will create a column for annual depreciation. Then I will have a column for cash flow. Okay. All right. So I'll do the same thing for project B. Year 1, year 2, year 3. So year, profits or loss. annual depreciation, then cash flow, which is what we are looking for. Therefore, now that I've designed my table for each of the projects, then I need to calculate depreciation because, okay, maybe before depreciation, let me input the profit or loss. So let's go back to the question. Profit for project A, year one is 58,000. Here is 58,000, a loss of 2,000 naira. Then 4,000 naira profit in year three, 4,000. For project B, 36, 4,000, 8,000. 36, 4,000 loss, 8,000 profits. So let's calculate annual depreciation now. Which illustration is this? You can see the illustration on the screen. It's illustration number 2. Illustration number 2 is what we are solving. Somebody that is asking which illustration is this. All right then. So annual depreciation, working number 2. Depreciation. Depreciation is equal to the cost of the projects minus scrap value divided by the useful life of the projects. So for project A, the cost of project A is 200,000 naira. The scrap value of project A is 14,000 divided by the useful life of 3 years, which is equal to, bring out your calculator, 186,000 divided by 3 equal 62,000 naira. So annual depreciation for project A is 62,000 naira per annum. Then I will do for project B equal. The cost of project B is 120,000 naira minus 12,000 naira depreciation divided by 3 years equal, again, 108,000 divided by 3 equal 36,000 naira. So now that I have the annual depreciation for each of the projects, so I need to go and add it to the annual profit or loss. So here is 62,000. Annual 62, 62, 36, 36, 36. All right. So to now get the cash flow, add it together. Here is 120,000 naira. Here is 60,000. Then here is 66. 72,000. 32,000. Then 44,000. So I've calculated the cash flow. So at this point, I need to go ahead and solve the question. Now I'm free. I'm good to go to calculate net present value, IRR, and payback period because I already have the cash flow calculated. So let's go up there. One 60, 66. So I would then say calculating A, Roman figure 1, calculating net present value. Please, on the day of your exam, your net present value should be written out in full. Please don't abbreviate. Okay? So what I will do is I'm going to merge project A and B together on this table. Therefore, I will create a column for here, description of items, okay? Description of items, then cash flows, discount factor, because the project will be affected with the same discount factors. So why should I create two different tables? So I will go back to the question, what is the cost of capital? 10%. Here is 10%, then the present value. So here is project A, project B, project A, project B. Here 0, 1, 2, and 3. We are calculating net present value. Remember, NPV represents the difference between the present value of cash inflow and the present value of cash outflow in capital investments. Therefore, first thing first, let's calculate the present value of cash inflow and the present value of cash outflow. Here is NPV. All right then. So initial outlay will be in year 0. That's the amount you are investing on the project. Project A is 200,000 we are investing. Project B, 120,000. Let me write that. Discount factor at year 0 is 1. 1 multiplied by 200 is 200,000. 1 multiplied by 120,000 is 120,000. In year 1, cash flow. Year 2, cash flow. Now, in year 3, the projects have scrap value. So in year 3, I'm going to combine cash flow plus scrap value. Since in year 3, the same discount factor will affect the cash flow as well as the scrap value. So I can merge it together. I would then say cash flow plus scrap value. So cash flow in year 1 for project A is 120,000 naira. For project for year 2, project 2, year 2 is I think 60,000. Let me confirm. Please, I need you guys to be giving me numbers 60, then 66, so that I don't need to be flipping between pages. 60, 66. So here is 60,000 for year 2. The cash inflow for project A as year 3 is 66. Scrap value is 14,000 naira. So 66 plus 14,000 will give us 80,000 naira. So here will be 80,000. I'm merging cash flow plus scrap value. Discount factor at year 1, 10% is 0.909, 0.826, 0.751. So we need to multiply to get the present value. Therefore, 120,000 multiplied by 0.909 equal 109,080. 109 and 80,000. Year 2, 60,000 multiplied by 0.826 equal 49,560. Then year 3, 80,000 multiplied by 0.751 equal 60,080. So we need to get the NPV. I would then say 60,080 plus 60,080 plus 49,560 plus 109 and 80 equal 218,720 minus 200,000. This will give me 18,720 positive. How did I calculate discount factor? Okay. Follow me as I'm be doing the second. Okay. You're asking how I calculated discount factor. Discount factor is calculated DF. Discount factor is calculated as 1 plus discount rates raised to power minus 1. So which is equal to 1.1 raised to power minus 1. So this will give you 0.909. Okay? All right. So let's go for project B, cash flow of project B. The cash flow of project B 72,32,44. 72,32,44. 72,000. 32,000. Then 44 plus scrap value of 12,000. That will be 56,000. So let's multiply 72,000 multiplied by 0.909. Okay. Equal 65,448. 65,448. Then for year 2 cash flow, this is 32,000 multiplied by 0.826 equal 26,432. 26,432. Let me write this one. Then year 3, 56,000 multiplied by 0.751 equal 42,056. 056. Add it up. Plus 26,432 plus 65,448 equal 133,936 minus 120,000 equal 13,936. 13,936. So that's the NPV of project A and B. And the two projects are financially viable because the NPV are positive. So requirement number 2 now. Hi. Calculating internal rate of return. Now, based on my explanation with you last time, I told you that when calculating internal rate of return, there are 3 procedures you must carry out. The first procedure is to assume 2 discount rates that will produce 2 opposing NPV, meaning that one discount rate will give you 1 positive NPV, then another discount rate will give you a negative NPV. Step 2, you proceed to calculating the internal rate of return using IRR's formula. Then step 3, you advise. But in this particular requirement, examiner did not ask us to advise. Therefore, you only have to calculate approximate internal rate of return. So what am I supposed to do? I need to assume 2 discount rate that will give me 2 opposing NPV. Please let me clean this space. I need that space. Okay. Therefore, let's assume 15% and see what we are going to get. So I will create a column for year, description of items, cash flows, discount factor, I don't know yet. So we are going to have a double discount factor. Then projects present value. Okay. Project A, project B, project A, project B. Okay. Year 0, 1, 2, and 3. Net present value. Initial outlay. Project A, 200,000, negative, 120,000, negative. Cash flows. Cash flow plus fair value. Cash flow of projects A, year 1, 120,000. Project B, 72,000, 60,000, 32,000, 80,000, 56,000. So discount factor. We are going to have 2 different discount factors. First thing first, we are assuming 15%. 15%. Therefore, here will be 1 multiplied by 200 is 200,000. 120,000. Okay. So at 15%, bring out your calculator. Discount factor at 15%.
0.870 approximately.
0.870. Thank you. Year 2. Year 2.
0.756.
0.756.
756. Okay.
0.66.
66.
Okay, 0.656. Sorry, 658. Sorry, 0.658.
Okay, 0.658. All right then. So let's multiply to get the present value. So I would then say 120,000 multiplied by 0.87 equal 104,400. Here is 104,400. Year 2, 60,000 multiplied by 0.756 equal 45,360. Then year 3, 80,000 multiplied by 0.658 equal 52,640. 52,640 plus 45,360 plus 104,400 equal 202,400. So there's a positive NPV of 2,400. Move to the next one. Project B, 72,000 multiplied by 0.87 equal 62,640. 62,640. Next is 32,000 multiplied by 0.756 equal 24,192. Year 3, 56,000 multiplied by 0.658 equal 36,848. So to get NPV, 36,848 plus 24,192 plus, let me redo that, 62,640 plus 24,192 plus 36,848 equal 123,680 minus 120,000. 3,680. Here is 3,680. So we assume 15% and we got positive NPVs for project A and B. So as it is, we cannot proceed to calculate our internal rate of return. We need to assume a higher discount rate that will give us a negative NPV. So as a result, let's create another table. This one will now, yeah. Discount factor DF at 15%. So let's create another table for a negative NPV. So we need to assume a higher discount rate in this time around. So I'll create a column for year, description of items, cash flows, discount factor at, let's say, the 2,400 and 3,680 is closer to 0. So at this point, let's assume 20%. 20%. Anything above 18%, we should be able to get a negative NPV. But to be on the safer side, let's assume 20%. So that we don't just be doing iteration, trial and error. So project A, project B, A and B. Okay. Year 0, 1, 2, and 3. Okay. Net present value. Initial outlay, 200,000, 120,000. Okay. 120, 60, 80. 120,000, 60,000, and 80,000. Cash flow plus fair value, 72,000, 32,000, then 56,000. So discount factor at 20% for year one, 1.2 raised to power 1 minus equal 0.833, 0.833. Year two, 1.2 raised to power 2 minus equal 0.694. Year three, 1.2 raised to power 3 minus equal 0.579. Here is 1 multiplied by 200 is 200. 120,000 multiplied by 120,000. Therefore, 120,000 year one multiplied by 0.833 equal 99,960. Year two, 60,000 multiplied by 0.694 equal 41,640. Year three, 80,000 multiplied by 0.579 equal 46,320. Add it up. Plus 41,640 plus 99,960 equal 187,920 minus 200,000 equal 12,080. So here is 12,080 negative. You can see, which means that if we assume anything from 17%, we should be able to get a negative NPV, but this is okay. Move on. 72,000 multiplied by 0.833 equal 59,976. 59,976. Next one, 32,000 naira multiplied by 0.694 equal 22,208. The last one, 56,000 multiplied by 0.579 equal 32,424. 32,424. So 32,424 plus 22,208 plus 59,976 equal 114,608 minus 120,000 equal 5,392. Here is 5,392 negative. Now, we assume 15%, we got positive NPVs for project A and B. We also assume 20%, we got negative NPVs for project A and B. So step 2 says we should calculate internal rate of return using the IRR formula. Therefore, IRR equal to lower discount rates plus NPV of lower discount rates divided by NPV of lower discount rates plus NPV of higher discount rates. All of this multiplied by higher discount rates minus lower discount rates. Project by project. So project A, IRR of project A, we assume 15% lower discount rates plus NPV of lower for project A is 2,400. 2,400 divided by 2,400 plus NPV of higher rates, which is 12,080. All of this multiplied by 20%, higher discount rate minus lower discount rates. So I would then bring out my calculator to say 2,400 plus 12,080 equal, that's 14,480. Therefore, 2,400 divided by 14,480 equal, multiplied by 5 equal, plus 15 equal 15.83. Here is 15.83%. So I will then go for project B. Equal, lower discount rate is 15% plus NPV of that 15% for project B, 3,680. 3,680 divided by 3,680 plus NPV of higher, 5,392. All of this multiplied by 5 equal, bring out your calculator, 3,680 plus 5,392 equal 1,792. Therefore, 3,680 divided by 9072. 1972. Let me confirm. Yes, 1972. 1972. Let me redo it. 3,680 divided by 1972 equal, multiplied by 5 equal, plus 15 equal 17.03. Here is 17.03%. So we just completed the calculation of internal rate of return. Please, so far, before we go to payback period, let me know if you have any question for me. Do you have any question for me, please?
Please, sir, the last calculation, that 1980, have been 1970 what? Please, sir, what and what did you add there? I didn't get that figure.
You have your denominator together, 3,680 plus 5,392. Okay?
Okay, yes, sir. Thank you.
Any question before I proceed to calculating the payback period?
Yeah, just a quick one. In determining the discount factor.
I can
you
hear
hear me?
you.
Can you hear me now?
Better.
Okay. In determining the discount factor to use for the IRR,
yeah,
is it just based on assumption?
Yes. Like
Okay.
like my explanation to you last time is that when you are calculating internal rate of return, you are expected to assume two discount rates. When you assume, that means it's subjective. So you are at liberty to assume any discount rate that you think is more appropriate. However, you can't just assume anyhow discount rates. Before you assume your discount rates, you need to consider the size of your cash inflow versus your cash outflow. What do I mean by that? When you look at project A, for example, by the time you add together the cash inflow of year 1 plus up to year 3, all the cash inflow, that's about 260,000 relative to cash outflow of 200,000. So you can't just increase your discount rate anyhow or reduce your discount rate anyhow. But that notwithstanding, again, consistent with your question, yes, you are the one that will assume the discount rates, and that is why the calculation of internal rate of return involves trial and error method. Trial and error method. A wise student may ask, maybe we have calculated internal rate of, you have calculated NPV before, and we used 10%, 10% discount rate given to us in the question, and we got a positive NPV. Can't we just increase from 10% to 20% to get a negative NPV? Yes, you can do that, only at this level. At professional level, under strategic financial management, you can't just increase anyhow, because that rate is not attainable in the market. There is no investment that can give you 100% of your that can give you 100% return of your capital, of your investments. It's not attainable anywhere. Therefore, it's not realistic. You can't just increase from 10% to 20%. But again, at this level, skills level, examiner can pardon you, saying that you are upcoming, so you can be pardoned. Therefore, if you increase from 10% to 20% straight because you are looking for negative NPV, examiner will pardon you. However, you have to follow the procedure for calculating IRR, and that's what we have done so far. Because you can see that I neglected the first table that gave us the positive NPV previously. I neglected because I don't need it for calculating my internal rate of return. My focus is for me to determine and follow the procedures. The procedure says that assume 2 discount rates that will produce 2 opposing NPV. Therefore, I started from 15%. When I assume 15%, it gave me a positive NPV for each of the projects. So I have to increase to 20% for me to get a negative NPV. And at the end of the day, I calculated my IRR. So this is what is expected of you. I repeat again. So yes, at this level, you can, because you are looking for negative NPV, you can increase from that 10% to 20% or 10% to 18%, whatever it is. Examiner will forgive you because you are upcoming. So that's that. Let's move on. Yes, Imam, I believe you are fine, right?
Yes, thank you.
You are welcome. So let's go to the third one, which says we should calculate. So requirement number 3. Hi. Calculating payback period. Now, remember, to calculate payback, we say payback period is the period usually expressed in years in which it takes cash inflow to equate cash outflow in capital investments. Payback period is a measure of liquidity. That is, how quick, how soon can a company recover or recoup the amount invested in a project. So payback period measures liquidity of a project. Therefore, how do you then calculate your payback period? We said there are 2 ways you can calculate payback period. One is that if you are given constant cash inflow, that is, for all the period, for the entire useful life of the project, your cash inflow is constant at a particular figure, then in that case, payback period will be calculated as ratio of cash outflow to constant cash inflow. You express it in years. But if you are given non-constant or irregular cash inflows, meaning that cash inflows that are different year on year, The cash inflow you have in year 1 is different from the cash flow you have in year 2. It's different from the cash flow you have in year 3. In that case, you cannot use formula. Rather, you are expected to use tabular method. So consistent with this question, the cash inflows are different for each of the years. Therefore, we can't use formula. Rather, we are going to use tabular method. So if that is the case, I will design my table. Say this is project A. Here is project A. So create column for year. Description of items. Cash flows. Then balance. Okay. Year 0, year 1, year 2, year 3, year 3. Now, when it comes to payback period, you remember that when we calculated NPV and then internal rate of return at year 3, we added together the scrap value plus the cash flow of that year 3 because they are affected with the same discount factor. However, when you are calculating your payback period, please separate your scrap values so that you are not using scrap value as a bailout factor. So you separate your scrap value from cash flows. All right. So year 1, initial outlay, cash flow, then scrap value, separate it. Then cash flow of project A, year 0 is 200,000. Balance is 200,000 at year 0. Then here is 120,000. After 120,000 is 60,000. Is it 60? Let me confirm. Yes, 60,000. Then we have 66,000. Scrap value is 14,000. Therefore, when you want to calculate your payback period, so from your calculator, 200,000 minus 120,000 will give me 80,000 balance. So at the end of year 1, we have recovered 120,000 naira from the amount invested in a project. We are left with 80,000 naira balance. 80,000 minus 60 will give us balance of 20,000 naira at the end of year 2. Therefore, when you get to a point when the outstanding balance is lower than the next cash inflow, you put a dash. You can see that 20,000 naira is lower than 66,000. Equal to how many years have we recovered? We have recovered for 2 years, year 1, then year 2. That's 2. Therefore, I would then say 2 plus outstanding balance of 20,000 divided by the next cash inflow of 66,000. So this should give me 2.30 years. 2.30 years. Remember, your payback period must be expressed in years because we said that payback period is a period usually expressed in years in which you take cash inflow to equate cash outflow. Therefore, let's calculate for project B. Same thing for project B. The year, description of item, cash flow, balance. Year 0, 1, 2, 3. Okay. Yes. Initial outlay for project B, 120,000. 120,000. cash flow, cash flow, cash flow, then scrap value. 72,000, 32,000. Then the third year cash flow is for project B is 44,000. Here is 44,000. Then we have a scrap value of 12,000. Therefore, 120,000 minus 72 will give us 48,000. So there is a 48 balance at the end of year one. Minus 32 will give us 16,000. So at the end of year two, we have 16,000 naira outstanding. So 16,000 is lower than the next cash inflow. I put a dash. Then I will calculate payback period. I've recovered for 2 years plus outstanding balance of 16,000 divided by the next cash inflow of 44,000 equal. I'll bring out my calculator. 16 divided by 44 equal plus 2 equal. That's 2.36 years. 2.36 years, which means that project B will pay back within 3 years. Or you can say 3 years, 2 years, 3 months. All right. So that's that. Now, to complete the techniques, we are going to calculate, we are going to add to the requirements given to us in the question. Then we are going to calculate accounting rate of return. Even though the examiner did not ask us to calculate accounting rate of return, but just to demonstrate to you how to calculate accounting rate of return, let's do that in this particular question. All right. So I would then say requirement number 4. Let me stop sharing and reshare the question again so that I can remove this mark on the screen. Okay. So let's calculate internal rate of return in addition to what we have done. So I would then say requirement number 4, calculating accounting rate of return. And you know that we said accounting rate of return is also known as return on capital employed or return on investments. It's a non-discounted cash flow technique that uses accounting information as shown in the financial statement of a company. And we said that accounting rate of return is a measure of profitability. Unlike payback period, which measures liquidity, accounting rate of return measures profitability. Therefore, how do you then calculate the accounting rate of return? The accounting rate of return is calculated as average annual profits, AAP, divided by average investments, AI, multiplied by 100 over 1. So this is the formula for calculating accounting rate of return. So as shown on this formula, I need to calculate average annual profit. Examiner will never give to you average annual profit or average investments. So it's your responsibility to be able to do that. Therefore, I would then say project A. I will also do for project B. Project B equal. So I need to go and calculate average annual profits. Okay. Average annual profits. Working number 3. Average annual profits is calculated as total profits divided by useful life of the projects. Now, the total profit in this question will be very straightforward. This is for project A. However, in a situation whereby cash flow is given to you in the question and you are required to calculate the account, you want to calculate the average annual profit. So to get the average annual profit, it is cash flow minus depreciation. I repeat, to get the cash flow, to get the total profits, so you are going to less cash flow minus depreciation. So that will give you profit for each year. Then you now sum everything together to get the total profit. Then you divide it by the useful life. But in this case, annual profit and loss have been given to us. So we need to just add them together and we divide by the useful life. So for project A, the first profit given to us on project A is 58,000. So here is 58,000. I want to get total profits minus the loss of 2,000 plus a profit of 4,000. 3 variables were added together, so you divide it by 3 to find the average. Therefore, I can then say, is it 50,000 or 58? 58,000. There is 58,000. So my calculator, 58,000 minus 2,000 equal 58,000. There was an error in that one. Minus 2,000 equal plus 4,000. That's 60,000. Divided by 3 equal 20,000 naira. Average annual profit for project A is 20,000 naira. I will do the same thing for project B. Equal profit of project B, 36,000 minus 4,000 plus 8,000. Then divide by 3. Okay, so this should be 32 plus 8. This will be 40,000. 40,000 divided by is 13,333. So we just calculated average annual profits. Working number 4 says we should calculate average investments. So average investment equal to the cost of the project plus scrap value divided by 2. If your scrap value is equal to, if you are not given a scrap value, then you put 0, okay? If you are not given a scrap value, put 0 there. So that 0 is a figure. So I would then say for project A, equal to cost of project A is 200,000. Plus scrap value of project A, 14,000. Divided by 2. This is 107,000. Then for project B, equal 120,000 initial outlay plus scrap value of 12,000 divided by 2 equal 130,000 divided by 2, that's 66,000 naira. Therefore, I can go up there and determine my accounting rate of return because I have average annual profits and I also have average investment. So for project A, average annual profit is 20,000 naira. So here is 20,000 naira divided by 107,000 multiplied by 100 over 1 equal 20,000 divided by 107 equal multiplied by 100. 18.69. Here is 18.69%. For project B, profit is 13,333. Average investment is 66,000. Multiplied by 100 over 1 equal. So 13,333 divided by 66,000 equal 20.20. Here is 20.20%. So that's that. We have completed the requirements. We have calculated. Now, because we compute for 4 different techniques, so it's important for you. You can just put your, even though it's not required, but it's a kind of group presentation. So it should be, advisable that you present your workings in a summary. Your solution, present it in a kind of in form of summary for the purpose of your decision making or analysis. Okay. No more page, no extra page on the main page. So let me go down here. So I want to advise. I would then say summary of results, especially whenever you have calculated for using more than one techniques, then it's better for you to put the final results in a summary form, in a summary table. So here will be projects. Here will be methods. Okay. So we have NPV, IRR, payback period. Then we have accounting rate of return. This guy is in Naira. Naira percentage. This one is expressed in years. Then this one is also in percentage. So we have project A, project B, then finally we have ranking and selection. Ranking and selection. Okay. All right then, on the basis of NPV, we calculated 18,720 for project A, 13,936. So on the basis of the net present value, which of the projects are you going to select? Which of project A or B are you going to select on the basis of NPV? I'm asking.
Project A.
Yeah. Projects.
Project A.
Okay. Yeah, you are correct. Project A has a higher positive NPV. So for projects under IRR, we calculated 15.83 for project A. Let me confirm that. Is it 15.83? IRR.
Yes, sir. 15.83.
Okay. 15.83. Then for project B, we got 17.03%. Therefore, on the basis of internal rate of return, which of the two projects are you going to select?
Project B.
Project B, correct. Project B has a higher internal rate of return. So relative to the company cost of capital of 10%. Then payback period of project A is 2.36 for project B. On the basis of payback period, which of the two projects are you going to select?
Project A.
Project A.
Correct. Project A should be selected. Project A produced a shorter payback period. All right. So accounting rate of return for project A, we got I think we got 16, 15, no, 18.69. 18.69. Here is 18.69, 20.20. So on the basis of accounting rate of return, which one are we going to select? On the basis of accounting rate of return, which projects are we selecting?
Project B.
Project B.
Project B, correct. Project B produced a higher ARR relative to the management predetermined ARR. All right then. So now that's that. However, examiner wants us to advise in the bill requirements, you have to state which, if any, of the two investment projects the company should accept and why. So let's make a decision. I would then say number B, requirement number B, advice. Okay. I will say project A produced a positive NPV of 18,720. Why? Project B generated a positive NPV of 13,936. This means that the two projects, the two investments are financially viable. However, since projects A and B are mutually exclusive, project A with a higher positive NPV should be accepted or selected. Okay. The decision The acceptability. The acceptability of project A is based on the net present value. Examiner is asking you to state the reason why, which of the projects should be selected and why. So you need to justify your position. And that's what we are doing right now. The acceptability of projects A is based on the NPV criterion. This is because net present value is an absolute measure of profitability. Profitability is an absolute measure of profitability. Therefore, a positive net present value will increase the value of a company, which will invariably maximize the shareholder value. The shareholders value. That's that. If you want to go further, you can negate, you can just state maybe one or two disadvantages of IRR, payback period, accounting rate of return to justify your position, but this is okay. So that's that. That's end of the question. Let me know if you have any question for me, please, so that we can move to the to another illustration on this. Let me know if you have any question for me. All right, then. So let's move to another illustration. I will stop sharing this working notes right now. So the last time ICANN tested capital budgeting, especially as compulsory question, was in 2016, very long time ago. And during the diet, in that particular diet, most tuition centers and the students and the student group were caught unexpected. We didn't expect the kind of question that the examiner tested. Without wasting more time, let's review the question together and see how to solve it, so that in case you find yourself or such similar question is being tested on the day of your exam, you know how to treat it. It's a complete question. So let's go through it together. Yeah, this is the illustration number 6, illustration number 5 rather. So this is the last question tested by ICANN as compulsory under capital budgeting. So I need somebody to read the question for me, please. Who will help us? Who will help to read it? Okay, Sam, please go ahead. Go ahead.
Kilimanjaro pays to December 31st each year controlled production facility on January 1, 2016 at a cost of 50 million naira. This will enable Kilimanjaro PLC to produce a new product, which it expects to be able to sell for 4 years. At the end of this time, it has been agreed to sell the new production facility for 1 million naira cash. Sales of the product during the year ended December 31st, 2016, and the next 3 years are expected to be as follows. Selling price, unit variable cost, and fixed overhead cost, excluding depreciation, are expected to be as follows during the year ended December 31st, 2016. The following rate of annual inflation are expected for each of the year during 2017 to 2019. Given the rate, the company pays taxation on its profit at the rate of 30%, with half of this being payable in the year in which the profit is earned, and the remainder being payable in the following year. Investments of this type qualify for tax depreciation at the rate of 25% per annum on a reducing balance basis. The Board of Directors of Kilimanjaro PLC has agreed to use a 12% post-tax discount rate to evaluate the investment. Required: A. Advise Kilimanjaro PLC whether the investment is financially worthwhile. B. Calculate the internal rate of return of the investment. Then C. Define the following terms: real rate of return, money rate of return. Then explain briefly how real rate of return and money rate of return would be applied in calculating the net present value of the project, of a project's cash flow.
Thank you very much, Sam. Yes, that is the question. In the first requirement, in the requirement number A, you are to calculate, you are to advise Kilimanjaro PLC whether the investment is financially worthwhile. Now, whenever you are asked to advise, evaluate, or determine the financial viability of a project, what examiner is simply asking you to do is to calculate the net present value. Except examiner says otherwise, you are required to calculate the net present value. Therefore, for this particular question, examiner wants us to advise the company whether the project should be undertaken. That is, whether the project is financially worthwhile or viable. Therefore, we need to go ahead and calculate the net present value. So I will stop sharing this documents so that I can move to the next, move to the working notes. Let me see my working note if I still have space. Okay, this is the last. Thank God. Let me add more. Okay. So 3, 4, 5, 6, 7, 8, 9, 10. Okay, additional 10 pages. All right. So may not be up to that. So illustration number, we are solving illustration number 5. Illustration number 5. Okay. That's it. Open. Okay. Solution. So illustration number 5. The name of the company is Kilimanjaro. PLC. So I would then say requirement number A. Calculating net present value. Restricting the numbers to thousands. Now, when I was explaining to you last time, I told you that if in a question you are given multiple variables, in the question you have selling price, variable costs, incremental, attributable, specific fixed cost, you have working capital, initial outlay, scrap value, and all of that. You have tax as well. There's inflation. Therefore, you cannot use the normal table for calculating your net present value. Rather, you are supposed to use the columnar format. So how do you then calculate your NPV using the columnar format? So let's do it together. First thing first is for you to outline your table. So we are starting, examiner wants us to calculate from 2016 up to 2019. That's about 4 years. Therefore, you are starting from year 0, year 1, year 2, year 3. Let me write this, the space is too much. Year 0, 1, 2, 3, and 4. Now, I will then go back to the question. I need to go and identify where I'm given information on tax. I want to know when I'm going to pay tax. Is tax going to be paid in the current year or in arrears? According to the question, when Samuel was reading, I noted some information there. We are told that the company pays taxation on its profit at the rate of 30%, with half of this being payable in the year in which the profit is earned, and remainder being payable in the following year. Meaning that first thing first, once I've determined my profits, I need to charge 30% of my profits in the current year. Then the balance of that 30% will be paid in the following year. So which means that this question will extend to year 5. Okay, to extend to year 5. So I will then come here, I'll put year 5, then I will have a column for working. Okay. I don't know the extent my table will look, but for now, let me see, let me draw a line here. I don't know the extent. Okay. Therefore, there are 5. There are workings. Okay. So the first item will be sales value. I will go to the question. You can't just put down sales value. You need to check from the question if you are given selling price. When Samuel was reading, I saw selling prices. So we are given selling price per unit as 1,200. Then we're also given inflation rate for selling price to be 5%. Therefore, I'm going to go and do working for sales value. So this page will be for my NPV. The second page will be for my internal rate of return. Then the third page will be for my workings. So I would then say workings. Working number 1, units. Before units, I need to create years. Years 1, 2, 3, and 4. This is the time for us to apply all the principles or concepts that we have discussed previously under this topic. So, number of units. We are told 100,000, 6 units, 100,000, 105. Here is 100,000. 105, 110, 108. Okay. These are 6 units. Then, working over 1. Let's determine sales value. Before you can get sales value, you need to multiply your selling price with number of units sold. To get your selling price, you go into the question if you are given inflation rates. In this particular question, the examiner has given to us inflation rate to be 5% for selling price. So I would then say selling price at 5%. I will go into the question, how much is selling price? Selling price is 1,200. Before you put down the 1,200, you need to confirm from the question, what is the nature of this your cash flow? Is it real cash flow or money cash flow? Examiner has told me that the selling price, unit variable cost, and fixed overhead cost, excluding depreciation, are expected to be as follows during the year ended December 31, 2016. Therefore, examiner has given me first year price. So if examiner has given me first year price, it means the cash flow given to me are real cash flow. So if they are real cash flow, then I need to compound it. I need to inflate it to get the money cash flow. Therefore, the 1,200 for selling price is in year 1 price. Therefore, I would then come here 1,200. Who is that person? So 1,200. Therefore, because I've been given the first year price, I need to inflate. My inflation should start from year 2. Remember, I told you, when I was explaining inflation, I told you there are general rules. And I mentioned specifically that when cash flow as stated in year 1 prices or first year prices, inflation should start from year 2, meaning that the first year price given to you is the base year price. You don't inflate the base year price. Therefore, because it is that base year price you are going to use to project for the future. Therefore, you should start inflating from year 2. The fact that you want to start inflating from year 2 does not mean that you are going to say 1,200 raised to power year 2. No, the first one will still raise to power year 1. Then you continue in that order. Therefore, to solve this particular question, I would then say 1,200 multiplied by 1.05 equal 1,260. Here is 1,260 multiplied by 1.05. What you have in your calculator multiplied by 1.05. 1323. Here is 1323. What you have in your calculator multiplied by 1.05 equal 1389. Here is 1389. Like this, I've inflated the selling price. Remember, when I was explaining to you, when I was doing the calculation, when I was explaining the concept to you, I mentioned and I demonstrated for you how you can convert money cash flow to real cash flow and real cash flow to money cash flow. I said that when you want to convert money cash flow to real cash flow, that means you want to make real cash flow the subject of the formula. So you are converting money cash flow to real cash flow. Therefore, money cash flow will be multiplied with 1 plus inflation rate raised to power minus n. When you do this, it means that you are discounting. You are discounting. Then, how do you then convert real cash flow to money cash flow? So you're making money cash flow the subject of the formula. Then to convert real cash flow to money cash flow, so you are going to multiply the real cash flow with 1 plus inflation rate raised to power n. When you do this, you are compounding. When you are compounding, it means you are increasing. You are increasing the number, you are inflating it. So this is what we have done. So we have converted the real cash flow given to us right now to money cash flow on our selling price. That's why you see that the selling price has increased from 1,200 to 1,389. So you don't need this formula that I demonstrated here for anything, but it is implied in the question, okay? So this is what you are supposed to do. Now, let's say the selling price, the inflated selling price is number B. Therefore, my total sales figure in thousands is equal to A multiplied by B. Let's multiply. Okay. So bring out your calculator. Here will be 120,000. The next one, 105,000 multiplied by 1,260 equal 132,300. 132,300. Next one, 1100 multiplied by 1,323 equal 145,530. 145,530. Next one, 108,000 multiplied by 1,389 equal 150,012. So with this, I've inflated the selling price. I've calculated my working for sales. I will do the same thing for variable costs. I will go to the question, am I given variable costs? If yes, then I need to do the similar thing as I did for sales value.
Yes, it's
So
fine. It's a dragger. I give you one. You
Victor,
give me
Victor,
two.
what's the
And I
meaning
give
of
you one.
this?
You give me.
Can imagine somebody that is in the class, variable cost. So variable costs per units. I will go to the question, what's the inflation rate on variable costs? We are told that variable production cost per unit, 750 naira. Then production cost is 8%. Therefore, at 8%, the first year price is 750. So I need to inflate my production cost, my variable cost per unit. Therefore, I would then say 1.08 multiplied by 750 equal 810. 810 multiplied by 1.08 equal 875. 875. What you have in your calculator multiplied by 1.08 equal 945. Here is 945. So I need to get the total variable cost. Total variable cost in thousands. Say this is C, then A multiplied by C. Here will be 75,000. Again, 105,000 multiplied by 810 equal 85,050. Next one, 110 multiplied by 875 equal 96,250. Next, 108,000 multiplied by 945 equal 102 and 60. Again, I've calculated for my variable cost. At this point, let me go and post. Please, you'll be calling the numbers for me. 120,000 for the first year sales. So here is 120,000. What's the second year sales? Samuel, give me the numbers, please.
132,300.
132,300.
132,300. Thank you. Next one.
145,530.
145,530.
The next one, 150,012.
150,000 and then 12 dash. This is working number 1. Variable cost. For year 1, variable cost 75,000. What about year 2?
Year 2, 85,050 naira.
85,050.
Year 3?
96,250.
96,250. Year 4?
102,060.
102. 102 what?
And 60.
Okay. All right, then dash, working number 2. So let's go back to the question. The next item after variable cost is variable selling and distribution cost, 100 naira per unit. So let's go and do working for that one too. Variable selling and distribution. Working number 3, variable selling and distribution. Variable selling and distribution at what's the inflation rate for variable selling and distribution cost is 6% inflation. So at 6%, the first year price is 100 naira. 100 multiplied by 1.06. 1.06 multiplied by 100. That's 106. 106 multiplied by 1.06 equal 112. 112. What you have in your calculator multiplied by 1.06 equal 119. Okay? That's it. Therefore, I need to multiply. Let's say this is D. Therefore, total in 1,000 equal to A times D. Here will be 10,000. Then 106 multiplied by 105. 11,130. Okay. Next one. 110 multiplied by 112. 12,320. The last one. 108 multiplied by 119 equal 12,852. All right then, so let's go and post 10,000. Here is 10,000. 11,320. This is variable selling. Selling and distribution. Year 3, what do you get, Sam?
12,320.
12,320. That means year 2 is not correct.
Yes, year 2 is 11,130.
Oh, okay. 130, right?
Yes, sir.
Okay. Then year 4.
Yeah, for 12,852.
852. Thank you. So let's move to the next one. The next figure we have here is a fish production cost for the year, 4 million naira. Please, I need you guys to participate. We are given fish production cost of 4 million naira. That 4 million naira, is it relevant or irrelevant? I need to know. The fish production cost of 4 million naira given in the question, is it relevant or irrelevant? Tell me, please. Yes. Fish production overhead. Sorry, fish production cost for the year, 4 million naira. That 4 million, relevant or irrelevant? Talk to me, I want to know.
It's relevant.
Relevant. Why is it relevant? Tony, you say it's relevant. Why?
It's irrelevant.
It's not relevant, Tony. Okay. Why is it not relevant?
Because I think it's a committed cost. It's a fixed cost that's already been apportioned. So irrespective of what will happen, it's already fixed. So it will surely happen.
Okay. So it will, since it will not change, therefore it's irrelevant, right?
Yes,
okay,
from my
then.
point of view.
Yeah. All right. So who again? Yes, Sam. The fixed cost of
Sir,
form
it's not relevant. It's irrelevant.
is
Because
irrelevant.
yes, sir.
Okay.
Because is a sunk cost, and from the question we are not given maybe it is incremental. Assuming it is
okay.
incremental now, we can say the incremental cost is relevant, but this one is just the fixed cost for the year.
Okay. Any one more person? Yeah, any other person that wants to try? The fixed cost of 4 million naira, relevant or irrelevant? If it is relevant, why? If it is not relevant, why? You have to justify your position. Yes. Okay. To save
It's
time,
relevant. It's relevant because it's a cash flow item and it's a real real money.
who is speaking? Hello, who is speaking? Your name is showing dots. What's the name? Hello? Okay. Now, let me explain to you once again. You will recall that in our last class, even prior to last class that we had, I mentioned to you that there are 3 ways examiner can test fixed cost in a question. I remember when I had when we had relevant costing for decision making, I mentioned that fact. I told you there are 3 ways examiner can test fixed cost in a question. Number 1 is that if you are given fixed cost, no additional information, examiner just give you fixed cost, no further comments. That particular fixed cost is irrelevant because irrespective of decision taking, the fixed cost will surely be incurred. Therefore, it is not relevant, provided the fixed cost will not change. That's 1. 2, I also mentioned to you that if you are given fixed cost, including depreciation, then it means that examiner wants you to do something. When you are given fixed cost including depreciation, you need to go ahead and calculate annual depreciation and less from the fixed cost. Whatever you have thereafter is irrelevant fixed cost that you have to account for. That's number 2. Number 3, I told you, if you are given fixed cost, excluding depreciation, it means that fixed cost is relevant. You have to account for it. Those are the 3 ways examiner can test fixed cost in a question. When you look at this scenario, when you look at this particular question we are solving, before the first table, before the number of units given to you, 2016, 2017, 2018, and 2019. No, before the cash flows, rather, before the cash flow, paragraph before the cash flows. Examiner told you that unit selling price, variable costs, fixed overhead costs in brackets, excluding depreciation, are expected to be as follows during the year ended 31st December 2016. So examiner has told you fixed overhead cost, excluding depreciation. It means that the fixed cost given to you, the fixed production costs, your fixed admin costs, all of them are relevant because examiner has told you that fixed overhead cost, excluding depreciation. Please, guys, you have to be very careful. It is not at all time that fixed cost is not relevant. I just explained to you. I've done it in some of our previous classes. I'm repeating it again now. How examiner can test fixed cost in a question, and I believe now that you know. Please, these fixed costs given to us in this question are relevant, so we have to account for them. That's that. Let's move on. So we are given fixed production cost of 4 million naira. So I don't need to do working for this one because it's not related to number of units. So I'll just say fixed production cost 4 million. That's the first year price. So what am I supposed to do? Let me rewrite this. Because of space. Fixed production cost. At inflation rates, the production cost inflation is 8%. So at fixed production cost at 8%. So I bring out my calculator, 4,000 multiplied by 1.08 equal 4320. 4320. 4320 multiplied by 1.08 equal 4666. 4666. So what you have in your calculator, multiply by 1.08 equal 5038. 5039. Here is 5039. I'm done with this. Next item, we're also given fixed selling and distribution costs. Fixed selling and distribution. So fixed selling and distribution at what's the inflation rate for selling and distribution? 6%. At 6% dash. The first year price, fixed selling and distribution is 2,000. Here is 2,000 multiplied by 1.06 equal 2120. Let me write that so that when you are adding 2120. Next item, 2120 multiplied by 1.06 equal 2247. 2247. Okay. What you have in your calculator, multiply by 1.06 equal 2382. That's that. I'm done with that. Next item. We also have fixed admin cost, 1 million. The fixed admin inflation rate is 5%. So fixed admin at 5%. First year price is 1 million. 1 million multiplied by 1.05, 1050. Multiplied by 1.05, 1103. What you have in your calculator, multiply by 1.05 equal 1158 dash dash. So I think we have accounted for all the cash flows. The next thing we need to do now is to find profits. Please give me the value. Add it up year on year. Add it up. Profits. Who is doing the addition, please? Let me do for year 4. Sam, you can do year 1. Let me do year 4. 150. Others should do year 2 and 3. 012 plus minus 102 and 60 minus 12,852 minus 5039 minus 2382 minus 1158 equal 26,521. Sam, which one are you doing now?
Year 1, 28,000.
28,000.
28,000, yes.
Thank you. So you can do year 2. Let me do year 3. I'm not sure others are doing the addition. They are not
Year
in
2.
class.
Year 2,
Yes.
28,630.
28,000.
630.
630. Thank you. So let me add year 3 also. Okay. Year 3.
Year 3, 28,944.
28,944. Thank you, Sam. Now, immediately after the profit, you are supposed to pay tax because tax are paid on profits. In any year a company make loss, you don't pay tax on loss. You carry it forward until you're able to make profits. Now, so if that is the case, the next item will be tax liability. In this particular question, examiner told us that our tax liability is 30% on the profits. Therefore, we are now told that 30% should be paid in the current year, the profit is earned, then the balance of 50% should be paid 1 year after. So you pay 50% of 30% in the first year, then the balance of 50% in the following year. So if that is the case, because we have tax are paid twice, so let's go and do our working for tax liability. Workings for tax liability. Before we calculate the tax liability, we need to calculate tax saved, or we need to calculate capital allowance. Now, I told you when I was explaining under implication of tax, I said that the purpose of tax liability, the purpose of capital allowance is to reduce tax liability. And I mentioned to you that when you want to reduce your tax liability, you can either use capital allowance or you use tax saved on the capital allowance. Whichever of the two that you use, you are going to get the same answer at the end of the day, but different ways of doing it. However, let's say working number 4, we want to calculate tax saved on capital allowance. Okay. So create a column for year. Narration. Cost. Then tax saved. On capital allowance at 30%. Company tax rate is 30%. So year 0, the cost is 50,000. Year 1, we claim annual allowance at 25% of 50,000. You have tax rated down value at the end of year 1. So 25%, 0.25 multiplied by 50,000 equal
12,500.
Thank you, Sam. 12,500. To find the difference, 37,500. So at the end of year 1, the tax rated down value is 37,500. Move to year 2. Examiner told us that tax capital allowance can be claimed on reducing balance basis at 25%. So year 2 at 25% of tax rated down value. So 25% of 37,500 equal
9,375.
9,375. So what's the difference? That's
26,125.
26.
28,125.
Okay, 28,125. So this is tax rated down value at the end of year 2. So year 3, the useful life of this project is 4 years. So year 3, annual allowance at 25%. So 25% of 28,125, what do you get?
7,031.25.
Okay. So 7,021 minus 28,125. That will be
21,094.
21,094. Thank you. You are my partner for tonight. So this is the tax rated down value at the end of year 3. Now, the final year is year 4. You need to compare the tax rated down value from the preceding year versus the sales proceed in year 4. Therefore, I would then say sales proceed the scrap value of the assets is 1 million naira. Therefore, 1 million minus 21 will give us 20,094. This 20,094 represents balancing allowance in year 4. Remember, I explained to you when we were discussing tax implication. I said that tax rated down value, when you are calculating at the final year of the assets, you need to compare the sales proceed versus the tax rated down value from the preceding year. So when the tax rated down value from the preceding year is greater than the sales proceed, it is called balancing allowance. But if the tax rated down value from the preceding year is lower than the sales proceed, it is called balancing charge. So if it is balancing charge, it's a bracket. If it's a balancing allowance, it's a plus. Balancing allowance is a tax profit, while balancing charge is a tax loss. Therefore, that's that. Now, these are the capital allowance. What we have calculated so far, this one, this, and then the fourth one, balancing charge, they are all capital allowance for the respective years. Therefore, if I want to reduce my tax liability using capital allowance. These are the numbers that I'm going to use. If I want to use tax saved on capital allowance, I will need to calculate my tax saved. So tax saved on capital allowance is company tax rates multiplied by the capital allowance for each year. Therefore, I will then say what I have on my calculator multiplied by 0.3 equal. This one is 2813. Here is 2813. Therefore, 12,500 multiplied by 0.3 equal 3,750. Here is 3,750. That's the tax saved on capital allowance. Then for the third year, 7031. 7031 multiplied by 0.3 equal 2109. Year 4, we have balancing allowance of 20,094. 20,094 multiplied by 0.3 equal 6028. Here is 6028. If I like, I can add up all my tax saved on capital allowance. So I have 6028 plus 2109 plus 3750 plus 2109, yes, plus 2813 equal 14,700. The total tax saved is 14,700. Here is total tax saved, TTS. So to confirm that, because you cannot claim above the capital allowance you are supposed to claim. So I need to confirm if I have not gone beyond my required capital allowance. So in this case, I can use formula to confirm that. I will say total tax saved equal to the cost of the project or cost of the assets minus fair value multiplied by company tax rates. So that must give me the same answer. So here is 50,000 minus 1,000 multiplied by 30%. So this should give me the same thing as 14,700. If not, I need to go and adjust the numbers to make up 14,700. Please, Sam, confirm if this 14,700 is correct. That's it. Okay, then. Let me check the messages.
Confirm, sir.
All right, then. Thank you. Okay, so now that we have calculated the, wow, time is fast spent. Okay, let's just complete this table. Now that we have calculated the tax saved on capital allowance, including the capital allowance itself, so let's then determine the tax liability. Working number 5. Yes, Sam, ask your question.
Sir, on a quick one, sir. In this capital allowance now, is it not
Yeah.
necessary to do initial allowance at the initial stage of the project?
No, because we are not given initial allowance rates, you ignore.
Okay.
You only calculate initial allowance if you are given initial allowance rates. Okay?
Sir, okay, sir.
All right then. So let's calculate tax liability. Because of time, I will use capital allowance to reduce tax liability. So I will then say tax liability for year 1, year 2, year 3, year 4, then year 5. So I want to calculate tax liability. I'll bring out the profits. The reason why we are doing it this way is because of the fact that examiner has told us that our tax liability should be paid twice, 50% in the current year than 50% balance of the 30% in the following year. So here is 28,000. Profit for year 2, 28 what, Sam?
28,630.
630. Year 3?
28,944.
944. Year 4?
26,521.
521. Thank you. So before you pay your tax liability, you need to deduct your capital allowance. I would then say capital allowance. So I want to use that capital allowance. In this our example, I want to use capital allowance to reduce the tax liability. When you look at the work and the PM material, the ebook I share with some of you, the ebook that you bought, you will notice in that particular one, I used tax saved to reduce the tax liability. But in this particular one, I want to use capital allowance to reduce the tax liability. Therefore, using the capital allowance to reduce that tax liability, I will pick capital allowance for each year. Capital allowance for the first year is 12,500. Here is 12,500. Capital allowance for the second year is 795, 9337 or 9375, I think. Let me go and confirm. 9375. Okay, yes. Then the third one is 7031. Then the last one is 20094. Okay. So before I begin to charge tax, I need to account for that. So let's find this one now represent the taxable profits. From the taxable profits for the first year, which is 28,000 minus 12,500, that's 15,500. At least we should be able to complete NPV. So we'll do the remaining one later on. 28,630 minus 9375 equal 19,255. Then the third one, 28,944 minus 7031 equal 20. What am I doing? 28,944 minus 7031 equal 21,913. Next, 26,521 minus 20,094 equal 6,427. So this is the taxable profit. So from this taxable profits, examiner has told you that tax liability is 30%. I would then say tax liability at 30%. Therefore, I would then say 30% of 15,500. Let me do that one. 30% multiplied by 0.3 equal. Here is 1928. Okay. 15,500 multiplied by 0.3 equal 4,650. Next, 19,255 multiplied by 0.3 equal 5,775,777. Next, 21913 multiplied by 0.3 equal 6574. Okay then. So now we have calculated the tax liability. Ordinarily, this is the numbers I'm supposed to deduct from my profits up there, but I can't do it like that. 65, I can't do it like that. So I have to, examiner told me that 50% of my tax liability will be paid in the current year. Therefore, the first 50% and the second 50%. Then I will add them together, total Okay. So 50% of 4,650. 4,650 multiplied by 0.5 equal 2,325. Here is 2,325 dash. Examiner told us the balance of the first year tax should be paid in the second year. Therefore, 2,325 second will be paid here, 2,325. Again, 0.5 multiplied by 577, 5,777 equal 2,889. Here is 2,889. The balance of 2,888 will be paid in the third year. Again, 6,574 multiplied by 0.5 equal 3,287. 3,287. The balance of 3,287 will be paid in the fourth year. 1928. Excuse me, 1928 multiplied by 0.5 equals 964. I will pay 964 in the current year. The balance of 964 will be paid subsequently. So I would then add 2,325, 515214. Please correct if I'm wrong. Here is 6175. I think 5, 6 plus 1. Yeah, correct. Then 964. Here should be 42. Let me add, use calculator. Plus 3287. Okay, 4251. Thank you, Sam. Then here is 964. So that's the tax liability. Please, you call the number for me. Let's go and post now. Let's go and post. Okay, thank you for those that are providing numbers in the chat box. So let's go and provide the numbers. 2,325 in the first year. 2,325 tax liability. 2,325. So here is 2,325 minus second year.
5214.
5214.
6175.
6175.
4251.
4251.
964.
964. Thank you. I think this is working number 6, if I'm correct. So after tax liability, we are not using tax saved on capital allowance to reduce our tax liability. So we are using capital allowance, and that's what we have done. Okay. So if I want to use tax saved on capital allowance, what I will do is that I will first of all, I will multiply 30% on the taxable profits. I will go and do my working, multiply 30% on this profit. Then I will now account for 50% of the 30% for the first year, the balance of 50% the following year. So I will get that one, then I will come and post. My capital allowance, my tax saved on capital allowance that I've computed, I need to account for 50% in the current year, then balance of 50% in the following year. I will add it together, then I will come and post in this one. So the difference between my tax liability and the tax saved on capital allowance will give me the same amount as this number that you have here as your tax liability. So for those of you that bought the ebook, when you look at my solution there, under this particular question, when you look at the solution, how I treated the tax liability, you see that the difference between the company tax liability and the tax saved on capital allowance will give you the same amount as you have it there. It's the same thing. All right. So the next thing will be scrap value. Scrap value is 1,000. Please, it is possible the student can make a mistake. because the examiner has told us that 50% should be paid in the 5th year. Our tax has extended to the 5th year. A student can make mistake on scrap value and put it in the final year. Final year for this project is year 4. It's because of tax we are extending to year 5. So after scrap value, I will consider initial outlay. The initial outlay is 50,000. So according to the question, there is no working capital. Therefore, let's find the net cash flow. Here is the net cash flow. We're almost there. 50,000. Let me rewrite that. So we have net cash flow. We have discount factor. Examiner say we should use cost of capital of 12%. Here is 12%. Then we have the present value. Then we have the net present value. That's it. That will be, once we get the net present value, that will be the end of today's class. Okay. Oh, that's wrong. Somebody should be adding the numbers. Sam, you're my partner tonight. We are be adding the numbers.
Year 1, 25,675.
25,675.
Year 2, 23,416.
23,416.
Year 3, 22,769.
23,769. 22,769. Year 4?
Year 4, 23,270.
23,270. Then here is 964. All right then. So let's calculate. Of course, this is 50,000 negative. So let's calculate discount factor at year 1, 12%. So here is 0.567, 0.567. So 1.12 raised to power 1 minus equal 0.893. 893. 1.12 raised to power 2 minus 0.797. 797. 1.12 raised to power 3 minus equal 0.712. Here 4, 1.12 raised to power 4 minus equal 0.636. 636. All right then. So let's multiply. I know this one to be 50,000. So multiply for me, please. Let me do for year 5. 964 multiplied by 0.567 equal 547. Here is 547 negative. Yes, Sam, what do you have there?
Year 1, 22,928.
22,920.
928.
928. Thank you. All right. 23,270 for year 4.
Year 2.
Yep, year 2, give it.
18,663.
663. Okay. 23270. What's wrong with you now? 23270 multiplied by 0.636 equal 14,800. Yes, year 3.
Year 3, 16,212.
16,212. So what you are going to do is to add up the positive present value first. You are going to add up all the positive present value, 22,928 plus 663 plus 16,212 plus 14,800 equal 72,603 minus the negative 50,000 minus 547 equal 22,056 positive. So that is the NPV. At this point, I need to advise. Examiner says we should advise Kilimanjaro PLC whether the investment is financially viable. I would then say the investment is financially worthwhile considering the positive NPV of 22,056,000 naira. Therefore, the investments should be accepted. That's it. So this is not the end. You are supposed to state your assumptions. All the assumptions that you have made in the question, you are expected to state it. If there's any figures you have ignored in the calculation of your NPV, you are supposed to state the reason why you ignored them. Most especially, whenever you want to, when you are calculating for NPV, certainly you are going to make some assumptions. So for you to be able to earn your full mark, so you need to state your assumptions. You then say the calculation above is based on the following assumption. You talk about cash flows. Okay. Number 2, in your cash flows, you can say it is assumed that the cash flow estimates are realistic and will occur at the end of each year let me write that, at the end of each year. I can then say further that all cash flow estimates have been inflated at the appropriate inflation rates. You only say this if in the question you have inflation, like in this question we are solving. Then assumption number 2. You can talk about cost of capital. What assumption are we making on cost of capital? You say it is assumed that the cost of capital of 12%, given is appropriate is appropriate and consistent with the cash flow. Consistent with the cash flow. Because we have converted money cost, we have converted cash flow to money cash flow. Therefore, we have to use a cost of capital that is consistent with that cash flow. So this 12% is assumed to be money cost of capital. Then number 3, we talk about inflation. What's our assumption under inflation? You can say that it is assumed that the specific inflation rates will remain constant. Let me write that also. Will remain constant within the relevant range. Or will remain constant just within the relevant range. Because if your inflation rates on the cost increases, it may impair or it may change our decision to accept the project. So any other assumptions we have made in the question, we have to consider them. So let's stop it at these 3 assumptions. Let's stop at these 3 assumptions. All right. Okay then. Guys, let me hear from you. This is where we are going to call it a day. I've extended beyond the required time. You can see it's a very big question, and it's not something we can just we have a short, we have a constraint, which is limiting factor. So let me hear from you, please.
Okay, sir. Quick one. I have 2 questions. The first one is concerning money money cash flow, that is nominal cash flow and real cash flow. So nominal cash flow is like the actual amount without any inflation or considering time value of money, while the real cash flow is considering inflation and the rest. So I'm saying in that workings you showed us, or the solving you showed us now. So is it like when it's money cash flow, that's when we now discount it. We now discount to get the real cash flow. Then when it's real cash flow, we now compound to get the money cash flow.
What's the name? I asked for your name the other time. You did not respond. Your name is showing dots. No name. What's your name?
My name is Adewale.
Adewale. Okay. Hopefully I will remember next time. Now, you asked a question that's on money cash flow, real cash flow. What you just said now is opposite of what I explained. I said that money cash flow, when I was defining for you last time, when we started this topic under inflation, I mentioned to you that money cash flow are cash flow that include or that incorporates the possible effect of inflation. They are inflated cash flow. Money cash flow has already been inflated. Do you get?
Okay.
So, but real cash flow, I said real cash flow are cash flow that does not include the possible effect of inflation. They are cash flow that is stated in year 1 prices, year 0 prices, today's prices, or current value times. So when you are given cash flow and examiner mention first year prices or current value times, you need nobody to tell you that they have real cash flow. So in this particular question of Kilimanjaro, examiner has given to us first year prices, meaning that all the cash flow given in the question, they are real cash flow. So we need to convert it to money cash flow. And that is why you see that we inflated them in order to arrive at money cash flow. Because when you compound the real cash flow, it means that you are inflating it to get the money cash flow. So hope that is clear. Wale.
Okay. So, sir, what you're trying to say now is that what we are giving the question is real cash flow because it's stating as at the end of 2016. The figures are at the
Correct.
end.
Yes, the figures are at the end of year 2016. 2016 is the first year. So meaning that all the figures given to you there, they are real cash flow because we are given first year price. And that is why when you look at our workings, from our workings, we inflated the selling price. We also inflated all the variables. We inflated variable costs, we inflated fixed costs, fixed admin, and all of that because they are real cash flow.
Okay, so normally when we are calculating this cash flow, the normal figures we are getting, they are usually the money cash flow. That's why we are discounting it to get the real cash flow. The NPV is not the real cash flow or something.
It's not a matter of NPV. We are looking at the cash flow, not the NPV.
No, I'm not saying like when we are calculating NPV, we consider cash flow, cash inflow and cash outflow, and we not discount. So those cash inflow, those cash out inflows, they are like the money cash
money cash flow, yes. Because when you look at, let me show you. Now, when you look at our calculation here, you will see that all these ones, all the numbers that you have here from the sales up to fixed admin, they are money cash flow. You have converted the real cash flow to the money cash flow. So they are now money cash flow. Do you get?
Okay, sir.
So they are now money cash flow. All right.
Okay, sir.
Any other question?
So, second, please, considering these fixed costs.
Yeah.
Okay, so you give us three scenarios where fixed costs are given. When fixed cost is given without additional information, you said it's irrelevant. You said when fixed cost is given with including depreciation, you said it's relevant. I will calculate depreciation, annual depreciation, and less it on the fixed cost, and the remaining fixed cost is relevant. Then you said fixed cost excluding depreciation is relevant. So I'm not asking what's the difference between the third and the first? No additional information. Then fixed cost excluding depreciation.
That's different now. It is the third one and the first.
That means there will be an additional information.
So once you are given fixed cost, what did you say?
Sorry. I'm trying to understand you. You are explaining something.
Go ahead with your question.
No, you said I'm asking the difference between the two.
You have seen the difference now. You say what's the difference between the first one and the third one? You can see the first one, no further information. The third one, examiner has told you that excluding is the main thing there. Once you are given fixed cost, excluding depreciation is relevant. You have to account for it. Okay?
So what if they don't give us additional information? They say there's a depreciation, but they didn't state it's included in fixed costs. We are going to assume that it's excluded.
So if you are given fixed costs,
yes,
you are now given the depreciation separately. Except examiners linking it. If examiner linking with the fixed cost, that's only when you consider that. Other than that, just ignore. Move on. Depreciation is not a cash flow.
Okay, so if they give us fixed cost and they give us depreciation in additional information, but it doesn't link it to the fixed cost.
Ignore. Ignore.
Okay, thank you, sir.
You're welcome. Any other question, please? I will stop sharing this. And yes, we have to call it a day. Thank you guys for your time and understanding. I will see you next time by the grace of God. Good night.
Good night, sir. Thank you, sir.
Good night, Sam. Thanks for your support.